Let's take a look at what we can expect from some other big names reporting this week. Carter Braxton Worth is looking at one name that he says you should buy into earnings, one that you should sell. Carter, what say you?
Well, there are a lot of good ones, but before we get to the charts, I mean, just to put the IBM in perspective, at 112 billion market cap, the implied move from Apple is about 5%. Were Apple to go up 5%, it's the equivalent of IBM being wiped out. Zero. Has almost no impact on the S&P. Sort of tragic, but there we have it. In any event, a few charts. Sherwin-Williams, first chart. This is a conventional buy juncture. A convention generally agreed upon as a stock that's toying with the prospects of breaking out is a stock to be bought. We see how a PayPal breaks out. We saw how Facebook or Amazon. And so while this is not a tech stock, it is a well-defined juncture, and you can see the lines drawn there. The presumption is an earnings beat will cause the breakout. So here at the 600 plus minus level, we think this has got a good 8 to 10% move coming. By contradistinction, look at Coke, next chart. This is an unhappy situation. I mean, down 1.5% today, a big up day for the market. And Coke is working its way into the apex of whether you call it a wedge or a triangle, it doesn't matter. What it means is decision time. It's often fundamentals that resolve the pattern, just as it's likely to be a breakout that resolves Sherwin. In this case, it's likely, I think, to be an earnings miss or something that's not welcomed that would cause it to break down. So Coke, don't like it. Now, just for fun, two more charts. Here is a comparative chart. Take a look at both Sherwin and Coke over the past year and a half. And it's not to say that what is obvious, Sherwin is outperforming Coke. What we know is the following. Look at the final chart. Now, what we've got here is the same chart, but we've included the S&P 500, the flat line, and held it as a constant. So this really exposes the actual relative performance of Coke. Coke is literally week after week, month after month, plumbing new lows. Not good. Sherwin, we're a buyer. Coke, we're a seller.
Carter, thank you. Carter Braxton Worth, Cornerstone Macro.
You bet.
Brian Kelly, do you agree with Carter?
Yes. You know what? I do, particularly on Sherwin. If you think about what we've talked about at the top of the show here, where some of the changes that you're seeing in society are going to be permanent. People are saying, hey, I'm going to be spending more time at home. Maybe I should paint that spare room and make it into an office. And that's where Sherwin-Williams comes in. Secondarily, if you think about the psychology of a breakout to new highs, everybody who owns the stock has a profit now. So you don't have any overhang supply. So there's usually, when they do break out like that, they tend to trend pretty well. So I like that on the long side. Coke looks horrible. That's just as simple as that. It might get a tailwind from a weak dollar, but why not just put your money where the momentum is and go with Sherwin?
I feel like Dan and Tim have had dust-ups about Coca-Cola in the past. Dan calling it the purveyor of sugar water. Have at it if you want to be in it. Tim, are you still an investor?
Well, look, I mean, Paul Rabel's coming on the show later, so there'll be no yard sales until then. But I think with Coke, you have a case where the restaurant story is a very, very difficult story. So casual dining, et cetera, Coke's going to struggle till we get more clarity there. Having said that, Coke has been in transition for years. This isn't your father's Coca-Cola. It's certainly their focus and what type of core products. It's not about carbonated soft drinks. It's about vitamin water. It's about other drinks. It's about water. So I think they've refranchised. They've dealt with their bottlers. I think the balance sheet looks great. It's a stock I want to own in this environment. I get where the headwinds are, but I'm not running for cover now.